Okay, so welcome to the session, everyone. In the today's class, we will be discussing about the bond duration and the duration wala topic. Okay, I'll just write down duration. Duration. This is also called as Macaulay duration, everyone. Okay, but first of all, I'll talk about what duration is. Bracket में I'll put down Macaulay. Macular duration. Okay, this is also called as Macular duration. Now, why are we talking about duration? See, guys, my value of interest, value of my debt is actually dependent on the interest rate. Correct? Is dependent on the interest rate. How? Because if you remember, guys, what is the value of debt? It is nothing but the present value of all the future interest that we are supposed to receive. So if the value of interest will increase, the value of debt will increase as well. So there is a relation between these two. There is a relation between these two. So change in bond price is approximately the same in either direction. Is same in either direction. Now we have to understand one part over here. There is a concept called as macular duration. Remember, when market yield fall, the price of bond will rise. Market yield, guys, I'm talking about market yield. When you have to calculate the present value, you use market yield as a discounting factor. Okay, when you have to calculate present value, you use market yield as a discounting factor. So now, just remember this line, everyone. When market yield falls, the price okay. This is the major component or the concept behind the maculae duration or the duration or anything over there. Okay, you just need to remember this particular line. How to calculate macro duration, that is also very important. Okay, we'll solve one simple question as well, but it is not that tough. There's a formula that we need to follow, everyone, and that's it. Now, the formula is also very, I would say, time taking at first. First of all, you have to find out the present values. So I'll write it down as present value multiplied by that particular year. Present value multiplied by that particular year. Then you have to do a addition of this whole amount. Okay, addition of this whole amount. So basically, year 1 multiplied by that present value plus year 2 multiplied by that present value. This is what you will be doing, everyone. Then divided by sum of present value. This will give you macular duration. Okay, this will give you macular duration. Now the question comes in, sir, what is macular duration all about? Let's suppose, everyone, that you give your friend 10 toffees. Okay. He said, ki, yaar, I will give you two toffees in year 1, 3 toffees in year 2, and let's say 5 toffees in year 3. Now you will say, ki, okay, but how much average time I am taking to get my toffees back? A normal guy will say 3 years because that's when you are getting your 10 toffees back, right? But as per macular duration, you are getting your toffees back in only 2.3 years. You are getting your toffees back in 2.3 years only. Just calculated it before. How is that happening? As per macular duration, the question that you ask is ki, how long do I have to wait to get my toffees back, right? So now in the year in the initial year, you are getting some toffees back. In the later year, you are getting some toffees back. Now, your year and the toffees that you are getting, they are compounded together. Okay, they are combined together. So that because if you are getting something at a later stage in life, if you're getting something at a later stage in life, and if you're getting something at a recent stage in life, we have to find out the average value of these things. That is why we talk about macular duration. So basically the concept says that if you are getting more toffees in a particular year, we give more weightage to that year. But for the calculation part, we take up year one only. Matlab the weight for year one will be 1, the weight for year 2 will be 2. Okay, that is called as macular duration. Now, if I talk about bonds or debt where we use it, it talks about the average waiting time to get our money back. Okay, average waited time to get our money back. That is your duration. Now, when I talk about modified duration, everyone, modified duration. Now, duration pe what we were discussing, ki how long should I wait? Correct. Now, what will happen ki if your friend says ki yaar, I'll give you one extra toffee every year. I'll give you one extra toffee every year. So now you will definitely have to wait less. You will definitely have to wait less. Now, because of just one extra toffee, you have to wait less. Correct? This concept brings us to the modified duration, which states if interest rate change, if interest rates change, if interest rate changes, I would say, how much will bond price change? Okay, so this is the concept of modified duration, everyone. If interest rate changes by a particular percentage, how much will the bond price change? Always remember, a bond, a bond and interest are on a seesaw. So if a bond price goes up, sorry, if an interest rate goes up, bond price will go down. And if interest rate goes down, bond price will go up. Remember, I'll just create a seesaw kind of thing. I'm not very good at drawing, everyone. Okay. Bond, interest rate. These are at a seesaw. If interest rate goes up, bond will go down. And if interest rate goes down, bond will go up. This is your concept of modified duration. Formula is pretty simple over here. You don't have to worry over anything. Macular duration divided by 1 plus cost of capital. This is what we call as modified duration. Okay, so we have this question, everyone, where we have to calculate the macular duration. Now remember, I'll put down year 0, 1, 2, 3, 4. Okay. At the first, we have cash flow. Year 0, it will be, I don't need to worry about year 0. Still, I can, if you want, you can write it down. 8,000, 12,000, 4,000, 2,000. Okay, this is my cash flow. 8,000, 4,000, 12,000, 4,000, 2,000. Can I go and find out the present value? Given the cost of capital is 8%, we can directly do that. But I have to multiply for each year. I'll find out discounting factor is equal to 1 divided by 1 plus R is how much? 1.08 raised to the power 1. Close. Divide all and multiply this into this, which will give me present values, everyone. Now, present value into year will give me this multiplied by this. Correct. Now, can I go and find out the total over here? This is the total of present value into year, right? And can I find out the total of present values only? This is the total of present values only. Now, can I go and find out Macaulay duration, which will be equal to this amount divided by this amount, 1.9421. Matlab, you will, on an average, you have to wait 1.94 years to get your money back everyone. Okay. Now, in this question only, if I have to find out modified duration, if I have to find out modified duration, which will be equal to what is the formula everyone? Macular duration divided by bracket में 1 plus cost of capital will be 1.08. That is your cost of capital, 1 plus cost of capital. Yani modified duration is how much? 1.79 years. What is modified duration everyone? 1.79 years. So this is how this modified duration and macular duration is actually calculated everyone. Okay. Now we have certain theories everyone of interest rate, which is also called as yield curve theory. Yield curve theory. Now, how your interest rate works. This is defined using three theories, everyone. The very first theory is called as expectation theory. Expectation theory, right? Now, what do we understand from expectation theory? That everyone is feeling that interest rate will be higher at the later date, due to which what happens? Due to which what happens, everyone? Interest rate is always higher at a longer duration trend. Interest rate is already higher at a longer trend duration. That is called as expectation theory. Right. Liquidity preference theory. Liquidity preference theory. Now, as per this theory, the investor is deferring his consumption and requires a higher yield for as a compensation. So if you are giving it for 1 month, you will get less return. If you give it for 2 months, you'll get more returns. If you give it for 3 months, you'll get even higher returns. So for the longer you just put down your liquidity, for that time you are getting paid. Then we have market segmentation theory. Now, as per market segmentation theory, at different points of borrowing, at different intervals of borrowing, different group of people are sitting. And people who are sitting at longer term, people who are able to take long term loan are more, but people who can provide are less. This is one of the reasons why it is written in your book as well ki investing in the long run is little riskier. Why? Because there can be a lot of changes in the debt part. Hence, investing for 2-3 years in the debt is never considered as a secure form of investment. Why? Because your bank can get closed, or even these things can happen. Like the currency fluctuation can be there. There can be some geopolitical reasons. So all of these, because of all of these reasons, market segmentation theory states that interest rate at the starting age or the initial stage is always less than the interest rate which is provided at the longer duration time frame. Why? Because your money is going to get trapped for a longer duration only. That is your interest yield curve theory, everyone. Now you might have a question, sir, how can I calculate the uh, price of a bond? Okay. But remember, this topic is also given in technical article. Yeah, this topic is already given in technical article. Already given as a technical article. Make sure to read it once. This will be your homework, everyone, for today. This is what you're supposed to do. Okay, I'll write it down. So the question is, we have years to redemption as 1, 2, and 3. Coupon rate is given as 7%, 6%, and 5%. Market price is given as 103, 102, and if I have to come back and rewrite, my current value is 107 IR, the interest rate. Okay, this is what we are trying to calculate, everyone. Just a second. Okay, now I need to calculate IR, which will become 107 upon 103, which will give me value of how much, everyone? 3.88. Now next year, my interest is 102. Cash flow will be 2 only. Now there will be 2 cash flows. Year 1 may I'll get interest of 6% plus 1 plus S2, which is 1 6 divided by 1 plus R. 1 plus R will be how much? 6 divided by, multiplied by 1 upon 1 plus R, 1.0388. This is first, plus next year again I'll get 106 rupees. 106 rupees, right, divided by 1 plus S2. This is what we have to calculate. Even over here I have subtracted and everything. Okay, 1 plus S2. First of all, solve this bracket and take this value over here. 102. Calculator. 6 divided by 1.038. 102 minus 20 coming out to be 96.22 plus 106 1 plus S square. Okay, this is what we have already understood, everyone. Now, can we do some changes? For example, 1 plus S2 x2 plus y equal to 106 divided by 96.22. Divided by 0.22, give me 1.1 minus 1 is equal to answer is coming out to be 4.96. Just solve everything and you will get the answer as 4.96. Now again in the step number 3, you have to do the same step. Step number 1 you have to discount by 3.88. Step number 2 you discount by 4.96 and then you will get the value of step number 3 as well. So it is nothing new, nothing tragical that we have done. Earlier we used to calculate the present value. This year we already had the present value and we had calculated the interest rate. So this interest rate is nothing but the spot yield curve everyone. So it's nothing new, nothing big. Now we have one more topic which is called as spot curve valuation. So when I talk about curve everyone, so you will see that the interest rate is given in basis points, BPS, or they might use a word called as Sonia, they might use a word named as LIBOR. So how do they give it? They'll write down you can borrow interest at 3 plus LIBOR, and it will be given that LIBOR is nothing but 200 basis point. So LIBOR, Sonia, Esther is always given in divided by 100. So you will always have to multiply them by 100 to find the value. You will always have to multiply them by 100. For example, a coupon bond which is of 5%, 100 nominal value and redemption, and then we have the basis rates, spreads are already given. So now we have to use the upper question that we just solved. Interest rates are already given as 3.88, 4.96, and then whatever is the last one. This is your treasury spot. And at what rate you are going to get it? One question, but before I give you one question, guys, there is one very good technical article which is given on the interest rate yield and curve. Please make sure that you go through it once. Just make sure that you go through it once. It will help you a lot in the coming time period. Also, there's a topic of rating agencies which we have in our world or in our country that actually provides rating to the loan. For example, you will see if you have Grow or any Demat account, you will see that there's a rating written triple A, double A, triple B, double B, double A1, double A plus, double A minus. What does it show? It shows whether how risky the venture is. So the better the rating, the triple A, double A, the better it is. Okay. Now, what affects the rating? The risk in the industry, the risk in the country of the company, the earnings protection or whatever the future expectation is, and also the financial flexibility. Generally, these things are not tested, but just for the understanding, we have triple A, double A, triple B, double B, B, triple C, double C, C, and then D. Okay, this is the best rating that we have. In an exam, beta, they will give you the rating and they will ask you to find out the rate of interest. For an example, let's say if I take one quick example, everyone.
Sir, is it 1 plus s to the whole square or just square, sir?
Sorry, where? S2 ka whole square.
So 1 not whole square.
Yeah.
Okay.
Okay, let me show you how they will test you in the exam for the ratings. Okay, this is the question. Up they might give you that find out the interest rate for 3 years. For 3 years. How will you do that? Whatever the interest rate is. Acha, we have the rating of A, so we'll check over here. Global bond rate is 8%. General rate is 8%. The 8% pe will add up for how many years? 5 years. So A rating 5 years any 0.65. This is always given in spread or basis point. This will become 0.65 every.